It's Personal Finance Friday. Today we're talking about passive versus active investing, so stay tuned. And we're back with passive versus active investing. Let's get started on this one. This topic can get a bit heated between different financial advisors, the financial press, TV and radio pundits, etc. Who's right, who's wrong? Well, let's talk about some of the bigger issues that are involved with it. Up front, let me say that I am personally a proponent of passive investing. Try and say that 3 times fast. But I believe it's possible to be objective and give some pros and cons and a basic explanation of each without coloring it too badly or anything like that. All right, let's talk about the basic differences between these two approaches. Passive investing is the classic buy and hold strategy, the long strategy. But these days it has a bit of a twist to it. In years past, it was just buy a particular company or individual stocks on your own and just hold them forever, living off the dividends or anything else like that. But in modern times, we try and keep that away from individual stocks and go with a mutual fund or an ETF. And more typically, in today's environment, it's an index fund of some sort. The most popular being ones that you'll see are the S&P 500 index funds. But there are lots of different kinds of index funds out there that qualify as passive with different kinds of indexes. The point of doing it this way is that you're buying this big basket of stocks that represents the market to one extent or another, depending on the size of the fund that you're in, like an S&P 500 or a Wilshire 5000. But it tracks the market, and that's what you're invested in, the whole market. You're after long-term capital appreciation, dividends, growth, etc., not one-hit wonders and jumps in stock price based on a change in technology or something like that. Remember, passive investing is long-term buy and hold. Active investing is a much more involved process that involves someone acting as the portfolio manager. That portfolio manager is actively looking for undervalued stocks, perhaps, weaknesses in trade policies or trade differentials between countries, anything like that that might give them an advantage and a chance to profit. Those same managers are also trying to time the market, buying and selling when they think certain things are weak or certain things are going to go up or down, and they're jumping in and out of positions to try and take advantage of that. So with that brief description of passive and active given, let's talk about some of the pros of passive investing. Number one, ultra low cost. It doesn't take a lot of money, a lot of work to have a computer buy and sell stocks in and out of an index when it only changes once every few years. Number two, minimal tax consequences, particularly in a taxable account. Obviously, if you're holding in a qualified retirement account, there's no tax impact at all. But in a taxable account, as stocks are added to or removed from the index, there would of course be possibilities there. But generally speaking, because these investments are simply bought and held, the only tax consequence you have is whatever dividends they might generate on an annual basis. Number three, great diversification. These various index funds generally have more than 30 different stocks held within them. Some of them, like the S&P 500, of course, has that. The Wilshire 5000 has basically the entire market in it. So plenty of diversification across industries and sectors, various size companies, small, mid, large, etc. So those are the pros of passing. What are the cons? First up, there is no alpha. You're never going to do better than the market or the index that you're tracking, but you're not going to do worse. Number two, you're not going to hit it big on a single stock. Again, because you're tracking an index, a basket of stocks, sometimes a very large basket of stocks, no change in one of them is really going to affect it too much. All right, let's flip to the other side. Let's have some pros of active management. Number one is flexibility. The active manager can come and go with a stock or a mutual fund or both, any of the above, anytime they want to in pursuit of returns. Number two, hedging. These active managers can employ all sorts of buying and selling strategies, options and short selling and everything like that to make sure that they try and make a profit out of this as opposed to taking a loss. And number three, tax management. Again, assuming it's happening in a taxable account. An active manager can buy and sell stocks and in certain cases be able to offset gains on some stocks with losses on sales of other stocks. And of course, let's hit a couple of cons of active investing. Number one, it's relatively very expensive compared to passive. The fees for Active management, whether that's paying a professional advisor to trade for you like that, or paying a fund manager and their research team to pick and choose stocks inside a fund, makes that fund or that investment typically anywhere from 75 basis to 100 basis points higher, or more in some cases, than a passive fund. So that's perhaps 1.5% in some cases more expensive, and that's return that you don't get to keep. That's their fee for doing all that research and all that buying and selling for you. Number 2, active risk. Now, because these guys are pursuing these returns by buying and selling and doing research and everything else like that, what you get into is a situation of who's going to be right, and you don't know who that's going to be. When are they going to be right? Is the strategy that they're going to employ correct for the time that it's happening? And are they actually picking the right side or the winner in that transaction? You don't know who will get it right, when they will get it right, and what strategy will actually work. So there are lots of risks involved in active management. There's the potential, certainly, for great gains, but also the potential for great loss. All right, that's just a very, very quick overview of passive versus active investing. If you have any questions or comments, please leave them below. Hit like and subscribe. Share this with your friends if you think it would be useful to them, and we certainly hope that it does. And as always, thanks for watching, and see you next time.